Welcome back to the CryptoLabs YouTube channel. We got Colin, the Mace token. We actually have a Jiffy inside the UIG. If you're part of the UIG, big shout out. You know what I'm talking about when I'm talking Mace with hat.
It's coming.
Why it's coming. Why are APRs and APYs different? And we get this a lot is, hey, I entered a pool, I entered a position, and it said I'd earn 60% or 500%, but I earned diddly squat. Is something wrong? Did I do something wrong? Are they lying? What's going on there, Colin?
There's a lot to unpack here, but it's a good topic to have because it's not static. It is not fixed. It's not a fixed rate. It's not like a savings account in a bank where they tell you they're going to give you a 0.01% APR and that's what you get for eternity and
Good
potentially
deal.
even lower. Yeah, it's a pretty good deal. No, but we have to understand, hey, where's the money coming from? First, I think is a good place to start because the money that we earn as liquidity providers is coming from users who are using the platform, who are using the pools, using our liquidity to swap their assets back and forth. If you've been on the YouTube channel for a bit, you've probably heard us talk about that.
How
But
cool is that?
understanding,
Like,
it's so
you
cool,
are the
very
bank.
sustainable, very
You're the bank.
sustainable. Actually, yeah, just to throw in a little side story, I had a conversation with my mom a couple weeks ago, and she goes, "What did you do? What do you do for work again?" Right? And I basically described this thing, and I swear she said, "Wait, so it's kind of like a bank?" And I said, "Haha, it's exactly like that. We just do it decentralized in a decentralized fashion." So yeah, it's a pretty cool moment. But understand, to go back to it's not static. It's because the volume, we get paid based on the volume, based on how much assets are being swapped back and forth. And so if there's $1 million of volume being swapped back and forth, users are paying the fees to swap those assets. Those fees come to us. So if there's $1 million in volume one day when you enter, and then in the next 24 hours, only $50,000 of volume has occurred, well, that the fees that are collected from those two different volume metrics are going to be different. And that's where the return percentage of the APR fluctuates constantly. It will fluctuate up when there's high volume and it'll fluctuate down when there's low volume. And so when we think about becoming a bank, it's a very sustainable model because it literally is based on people trading and swapping their assets back and forth. And so I actually like it, Lucas. To be honest with you, I like it because what that means is that when there's more adoption and there's more volume and more excitement, generally that means more fees are being collected by me. And so
there was a portfolio someone
like
posted.
that.
They're doing 40% a month because volumes are so high on they're doing some Sui, some Orca, some stuff on Solana, and now a lot on base. 40% a month. Is that sustainable for the next 5 years? Questionable, most likely not. But if you learn the skill, you can constantly find the opportunity to keep your returns. That's a little excessive high, I'll just be honest, but to earn 10, 15, 20% a month in these markets is not out of question. In fact, it's actually pretty easy.
Yeah, definitely. I made a post in the community yesterday, actually last night, and I said, hey, just a reminder, if you're doing 6% a month or more, you are killing it. Yeah. You are absolutely killing it. To bring us back down to reality a little bit, like 6% a year is unheard of. I have a savings account where my emergency fund is, or whatever, my war chest. 5.5% a year. And it's like advertised as like the best. It is very good for traditional finance, but it's like that's per year. We're doing this, and that's like the low bar per month. And so anyways, just to bring a reminder of like 6% a month is killing it. You're smashing it at that point.
So anyways, I'm guessing clear what you're trying to communicate here is the returns fluctuate based upon the volume that day, but the way that different dexes will calculate it sometimes is it's a very recent period of time that they're calculating, hey, this is doing 280%. You get into it and you're like, why am I only earning, on average 100%? It's because you maybe a day or two ago, the volumes were high. Now the volumes are a little lower. So I like to test, like I'll put $100 into 6 different positions to test them. And I can see true returns over 24 hours, but even know that the next 24 hours could be drastically different, which is why we like to position ourselves and get us on chains and into protocols that are starting to attract TVL. So when the internet goes crazy for it, or crypto Twitter, we're already there. And our returns go from 100%. I'm in one that's doing 890% right now. This isn't a gamble play. It's just the volumes have increased. And I've been there the whole time waiting for everyone else to come join the party.
Yeah, being in position is a really key thing that we talk about, being market makers, right? Yeah, absolutely. It fluctuates constantly. And just so you know, when you're looking at a DEX or generally more specifically the tools that we use, they're generally capturing past data to reflect future returns, which, like I've talked about here, is a little challenging for us just to take that as face value because it is constantly changing. And so if they're looking at the last 30 days of data and they're saying at the last 30 days, this is what the volume has been in this pool, versus the liquidity, this is how much people have generally uh, got as a return at the price range that you've set. Last 30 days, that's a long time in crypto. So understand that when you're looking at the last 30 days, if there was 1 or 2 days of major spikes in volume, that's going to drastically change and alter the actual data that you're looking at. And so if you're looking at something that's included those 2 days of massive volume, you'd be like, whoa, I'm supposed to be getting 500% APR. But then it's like, okay, well, let's just say you were in the last 14 days, not where the volume spikes. And then it's like, oh, I'm only getting, right? I'm only getting 200%. That's a big difference. And so when you look at 30 days of data, just to summarize, when you're looking at 30 days of data and they have those big spikes of volume and you're not aware of it, you don't dig deeper into it, which is what in the UIG, what we teach people to do, dig deeper a little bit, right? Is that those APR projections are going to be different. And so Lucas is 100% right. I think a good way to do it is let me get in and let me calculate realized data, realized returns. Then you can say, okay, now if this continued out for the next 14 days, is this something that I would continue to want to be into? And just know that, again, it's going to keep fluctuating throughout those 14 days. So we actually have like a don't panic if, Lucas, we have like a don't panic if
I'll
section.
link the video up here because we actually did a YouTube video on this too. I'll link the video up here. Definitely check it out.
Definitely check it out. And it will help you remove the emotional reaction to this because you go, oh, okay. It's not that I'm losing money. It's just there's less volume today. Someone mentioned today. Yeah. Someone mentioned in the community, hey, the crypto people, leave on the weekends. Why is the volume so low? But then all of a sudden Monday morning comes and they're like, oh, it's back to where it was previously. So again, don't panic. Things fluctuate. Things are moving. Crypto markets move. We need to be in position to be able to soak that up as the bank. That's the way to summarize.
We look at history because that is obviously important, but I will use it to identify opportunities and there'll be another video out. So definitely stay tuned on the YouTube channel here in terms of like how do you identify these positions. But I also look to the future is how can I position myself? I don't really care where the volume is right now. Where is and this isn't even technical analysis at this point, but more fundamental analysis and more just looking at where are things going. Oh, Coinbase is looking to sponsor or they're injecting capital, or we have some big venture capital funds looking to, let's position ourselves here because once the volume comes, we'll ride price appreciation. I have 4 or 5x positions before, and I'm going to go for only 80% a year because no one's into that. I'm already there. And now it's all of a sudden 600, 700% a year. And I'm riding appreciation and I'm making money on all fronts. People are so reactive in this market and they're always chasing trends. Get in front of it. And obviously that's what we do in the UIG too, is like reports and getting ahead of things. 3 to 4 positions a week. How do we get ahead of this thing?
Absolutely.
So good.
Absolutely.
If you got something from this video, leave it in the comments. If you have questions or want us to expand on anything, leave it in the comments. If you didn't like this video and you don't like Mason with hat token or Rubik's token, you probably wouldn't still be watching. So do grab a free course because we do cover a lot of the stuff in the free course. Or if you'd like to join the UIG, it's a coffee per day and you will make more money than a coffee per day if you actually commit to this stuff. So check that out. With that said, like this video, subscribe to the channel, and I'll leave some videos here. I'll leave some rebalancing rules of ours. I'll leave some entering liquidity positions over here. I'll leave the don't panic if it video. Definitely do check that out. Spend a few hours on this YouTube channel, dive into the content, study this stuff. And with that said, we'll see you in some other videos.